Deciding where to open a new individual retirement account is a fundamental financial decision that shapes your long-term household savings. Many people begin their retirement journey by visiting a local bank branch, assuming all retirement accounts function in the same way. Others choose to open their accounts through an online brokerage firm to access a wider range of investment options. While both institutions support the same tax-advantaged account structures, the underlying assets and long-term growth potential differ significantly. A bank retirement account typically focuses on preservation and capital stability, utilizing fixed interest products like certificates of deposit. In contrast, a brokerage retirement account allows you to invest in equities, bonds, and mutual funds to build wealth over multiple decades. Understanding these differences in growth, fees, accessibility, and overall structure is essential before making your final decision. This detailed comparison outlines how both systems operate, helping you select the right account provider. First, let us examine how a bank retirement account is structured and the assets it holds. When you open a retirement account at a banking institution, the options for growth are generally tied to banking products. The most common vehicle used within a Bank IRA is a certificate of deposit, often referred to as an IRA CD or a simple savings account. These instruments yield a fixed interest rate over a set period, such as 1 year, 3 years, or 5 years. The rate is set at the time of purchase and remains constant until the product matures. This structure provides a high degree of predictability, as you know exactly how much interest the account will accumulate over the term. For individuals who are close to retirement or have a very low tolerance for market fluctuations, this predictability is highly appealing. Furthermore, bank retirement accounts are generally backed by federal deposit insurance. In the United States, the Federal Deposit Insurance Corporation, or FDIC, protects deposits up to $250,000 per depositor per insured bank for each account ownership category. This means that even if the banking institution faces financial distress, your principal balance is shielded from loss up to the legal limits. For risk-averse savers, this protection provides peace of mind. However, the trade-off for this protection is a lower yield. The interest rates offered by banks are often lower than the historical returns of the broader financial markets. Over a long savings timeline, this lower growth rate can make it difficult for your savings to keep pace with the rising cost of living, which is a major long-term risk. Additionally, bank accounts are simple to set up and manage, as most consumers are already familiar with the online interfaces and physical branch locations of their local bank. This familiarity reduces the barrier to entry for novice savers. You can often link your retirement account directly to your regular checking account for easy transfers. However, it is vital to remember that these accounts are designed to keep money safe rather than build a large balance through long-term market investment growth over a multi-decade savings horizon of time. Second, we will analyze the structure and operation of a brokerage retirement account. A brokerage firm acts as an intermediary, giving you access to the financial markets where you can purchase a variety of investment vehicles. Unlike a Bank IRA, which restricts your choices to bank deposits, a brokerage IRA allows you to build a portfolio using equities, bonds, mutual funds, index funds, and exchange-traded funds. This structure shifts the responsibility of choosing individual assets to you, the account holder, or to a professional advisor you choose to hire. The primary benefit of this approach is the potential for much higher compound growth over time. Historically, diversified portfolios of equities have provided average annual returns that exceed the interest rates offered by traditional savings accounts. However, the potential for higher growth is accompanied by market volatility. The value of your investments in a brokerage IRA will fluctuate daily based on market conditions, economic reports, and company performance. Your account balance will rise and fall, and during market downturns, you may experience temporary declines in your principal. Unlike bank accounts, investments in brokerage accounts are not FDIC insured. Instead, they are protected by the Securities Investor Protection Corporation, or SIPC. SIPC insurance does not protect against market losses or bad investment decisions. Rather, it protects against the loss of cash and securities if the brokerage firm itself fails. This distinction is critical to understand, as it means you carry the market risk associated with the specific investments you select for your portfolio. Managing a brokerage account requires a basic understanding of asset allocation and investment fees. You must decide how to distribute your funds among different asset types to balance risk and return based on your age and target retirement date. Additionally, you need to watch transaction costs and expense ratios, as these fees can reduce your returns over time. Many modern online brokerages have eliminated commission fees for standard stock and fund trades, making these accounts more affordable than in the past. Understanding these elements helps you build a more robust long-term retirement plan that supports your personal wealth goals as you age and prepare for the future retirement years ahead. Finally, we must outline the key factors to consider when choosing between a brokerage and a bank retirement account. The choice depends on your current age, your risk tolerance, and your retirement timeline. If you have many years before you plan to withdraw your savings, a brokerage IRA is generally more suitable. The historical growth of market investments can help your savings outpace inflation, compounding into a larger balance over time. However, if you are within a few years of retirement and your primary goal is to preserve the capital you have accumulated, a bank IRA might be an appropriate choice. The predictability of fixed interest CDs prevents market downturns from reducing your balance when you need to start taking distributions. Additionally, consider the amount of personal involvement you prefer. A bank account requires minimal maintenance once established, while a brokerage account requires you to choose a portfolio allocation and monitor it periodically. You can automate investments in index funds to reduce active management, but you still need to understand your asset mix. In summary, bank accounts offer stability and federal protection but have lower yields, whereas brokerage accounts offer market rate growth potential but carry volatility. By assessing your risk profile and timeline, you can select the provider that aligns with your long-term goals. By analyzing these aspects, you can choose a path that fits your needs. Both accounts have their role, and some savers use a combination of both to balance safety with growth. Reviewing your options helps you build a solid financial plan for the future retirement years ahead. Retirement Roadbook explains retirement concepts for people who want a clearer long-term plan. The channel covers 401(k), IRAs, compound growth, withdrawal basics, contribution limits, retirement mistakes, and planning frameworks in simple educational language without giving personal investment advice. This video is general retirement education, not financial, investment, tax, or legal advice. Rules, limits, taxes, employer plans, and personal goals vary, so verify current information and consult a qualified professional for your situation.